Hey there, and welcome to this explainer. I am absolutely thrilled we're sitting down together today because I'm going to be stepping in as your personal financial mentor. Look, there is just so much noise in the modern market, and we are going to cut right through all of it. Together, we're going to build a stable, incredibly low-cost portfolio that's designed to just quietly work for you for decades. No gimmicks, no overly complex Wall Street jargon, just direct, structured learning. Okay, quick question for you right off the bat. Why do incredibly smart, capable people so often end up sabotaging their own long-term wealth? Well, honestly, it almost always comes down to psychology. Instead of just sticking to the boring, reliable basics, we get hit with this overwhelming temptation to chase whatever's trending. We get desperate to be that one clever person who spots the next big thing. Picture this. Opening a modern brokerage account today is literally like walking into an airport-sized supermarket of complexity. You're instantly bombarded with thousands of highly specific, super flashy products. I'm talking AI ETFs, space exploration funds, clean energy baskets. Half of these things sound like they were dreamed up by a marketing department running on way too much espresso. It creates massive decision paralysis and, of course, the ultimate fear of missing out. But here's the truth. That endless variety, it's a total trap. So here is our game plan for today. We'll start with the trap of trend chasing, then look at the 4 core ETF types, uncover the hidden cost of fees, break down how expense ratios actually work, and wrap up with your 7-day investing checklist. All right, part 1, the trap of trend chasing. Let's learn to avoid the noise. Think about 2 completely different paths you can take. On one side, we have the roller coaster story of Alyssa. She desperately wanted to own the future by picking AI and biotech ETFs, basically building a portfolio out of buzzwords. And you know what? It was completely exhausting. Some sectors crashed, others swung wildly based on whatever was in the daily news. Now, on the flip side is the strategy we're focusing on today. It's broad, it's boring, and it's incredibly stable. As the old saying goes, you really don't have to predict the future to be successful, you just have to own the present. Moving on to part 2, the 4 core ETF types you actually need. Listen, these 4 fundamental building blocks will literally cover 95% of a beginner investor's needs. We've got broad U.S. stock market ETFs, total world stock market ETFs, bond ETFs, and cash-like or short-term bond ETFs. That's it. Just by zeroing in on these 4 blocks, you can completely eliminate the stress of trying to track 40 different niche market categories. Let's unpack these a bit. Broad stock ETFs, which includes both your broad US and total world ETFs, these are the absolute powerhouses of your strategy. By holding tiny pieces of thousands of companies across multiple sectors and countries, they act as the engine of your portfolio. You are basically capturing the overall growth of the entire global economy, rather than placing a massive, highly concentrated bet on a single, unpredictable sector. Now, if stocks are your engine, think of bond ETFs as your financial shock absorbers. They hold collections of government or corporate debt, and their main job is to just smooth out the ride, reducing the overall volatility and wild swings of your portfolio. And those short-term bond ETFs? Think of them as a super stable, highly secure waiting room for your cash when it has a short-term job to do. Actually, do me a favor. Grab a piece of paper right now and jot down a quick cheat sheet. Just map out 4 rows: US stocks, world stocks, bonds, and short-term bonds. Next to each one, write out the specific job it performs and when it's useful. Getting this organized onto one single page will instantly clarify your whole strategy and, honestly, permanently cure that FOMO. Okay, part 3, the hidden cost of fees, the silent portfolio killer. Take a look at this number, 0.85%. Doesn't seem like much, right? Well, let me tell you about an investor named Marcus. Marcus was this close to buying an ETF charging a 0.85% fee because the fund promised all these active tactical adjustments and, frankly, it sounded incredibly sophisticated. Less than 1% feels like a rounding error. But Marcus paused, realized it was a trap, and chose a broad fund charging just 0.05% instead. Let me show you why that decision was an absolute game changer. Let's do a really stark mathematical exercise to see what Marcus avoided. Imagine a $50,000 investment with a tiny 0.05% annual cost, compared to a 0.75% annual cost. Because of how compounding math works, over a few decades, that tiny fraction of a percentage point doesn't just cost you the price of a fancy coffee. It compounds into literally tens of thousands of dollars lost to fees. A higher cost fund is essentially a leaky bucket that has to constantly overperform just to break even. Which brings us nicely to part 4. how expense ratios actually work.
So, an expense ratio is simply the annual percentage fee charged by a fund, and it gets deducted automatically from your assets. You're never going to get a physical bill in the mail. Your portfolio just quietly earns a little bit less. If it's 0.10%, you're paying $1 per year for every $1,000 invested. Think of this fee like a slow, invisible leak in a tire, or like trying to pedal a bicycle with the brakes lightly squeezing the wheel. It's friction, and it silently slows down your long-term wealth compounding.
When you're optimizing your portfolio, you've got to watch out for some major red flags. If you're paying over 1% just for basic index exposure, you are absolutely paying too much. And if you don't actually know what your ETFs cost, that is a huge red flag right there. You also want to be fiercely protective against hidden costs, things like tracking errors, where a fund totally fails to follow its index, or really wide bid-ask spreads, which is the gap between buying and selling prices. All of this creates unnecessary, wealth-destroying friction. So here is where you take control. I want you to adopt a personal fee rule right now. Write this down. For my core ETFs, I prefer expense ratios below 0.20%. By setting this strict black and white rule for yourself, you are building an unshakable boundary against those overpriced, complex products designed to eat away at your hard-earned returns. And while we're setting rules, keep these two vital mentor guardrails in mind. Let's call them the coach's rules. First, always start broad before going niche. Second, if two funds are tracking similar markets, just choose the cheaper one. We want to prioritize those broad, low-cost index funds and happily leave the complex, expensive speculation to the gamblers. All right, final section, part 5, your 7-day investing checklist to put all this into practice. Let's lock this in with a self-paced momentum checklist for the next week. Day 1, review that 4-category cheat sheet you made. Day 2, jump online and look up one real-world example for each core ETF. Day 3, actually practice comparing a high-cost fund to a low-cost one. Day 4, flex those psychological muscles and actively ignore a news headline about some hot new sector. Day 5, revisit your cash safety net. Day 6, explain the 4 ETF categories out loud to a friend. Teaching is the best way to learn, right? And finally, day 7, schedule your next learning step. This checklist is going to totally hardwire these fundamentals for you. As we wrap up, I want to leave you with a pretty provocative thought to chew on. Ask yourself honestly, are you building a portfolio just to impress people at dinner parties with complex buzzwords? Or are you building a portfolio to quietly compound your wealth for decades? Look, long-term investing success has never been about clever category hopping. It's about beautiful, boring, low-cost consistency. Stick to your structure, fiercely control your fees, and just let the market do the heavy lifting for you. Thanks so much for joining me on this explainer, and happy investing.